Well, hi guys, welcome to this Money Control live stream. You're watching a fresh edition of Morning Trade with me, Nandita Khemka. Lots of cues to digest this morning as usual. We have mixed cues coming out of global markets, GIFT Nifty hinting at a muted but positive start for us, and lots of stocks and sectors in focus. Of course, particularly the banking and NBFC sector. The entire financial space will be in focus after, the RBI tightened norms for personal loans as well as credit cards as well. But of course, we'll be talking about the entire impact of that move on the financial space. Of course, we'll also be taking up all your stock related queries with our technical expert on the show. So if you have any queries, send them in to us on our YouTube feed and we'll try and take them up. But before we go any further, as usual, let's take a look at the top headlines at this hour. The November rally pauses on Wall Street with key indices ending mixed. The Dow ends a 4-session gaining streak while the Nasdaq and S&P 500 gain. Indices remain on track to post weekly gains. Asian markets come under pressure as the rally on Wall Street eases. The GIFT Nifty, however, is implying a flat start around that 19,800 mark for the index. Crude prices crack about 5% with the Brent hitting $77 a barrel mark, the lowest level since July. Supply continues to outpace demand and data suggests that demand could also be slowing from the Chinese economy. Banks and NBFCs may open lower today as RBI tightens loan provisioning norms to check the rapid surge in unsecured retail loans. The central bank raises risk weightage from 100% to 125%. Now, the decision is likely to slow down credit growth. And the stage is set for a crack of a final in the ongoing World Cup tournament. India will face Australia in the World Cup finals on Sunday as they look to bring home the cup after a gap of 12 years. Well, let me first, bring on board Milan Vaishnav, who's the founder at Gemstone Equity Research, to understand what the setup is looking like for the markets. For the Nifty particularly, it's somewhere around, we fizzled out after hitting that 19,800 mark. Are we, are the charts suggesting that we are going to resume that rally? Or do you think, of course, you will see some bit of reaction coming in on Nifty Bank Index as well, given the fact that the Nifty Bank Index slipped in the last half hour of trade, right? So do you think weakness in Bank Nifty could continue to, cap upside when it comes to the Nifty?
Well, good morning, Nandita and all the viewers. First of all, if you take a look at the Nifty, primarily speaking, Nifty is due for some sort of consolidation at the current levels. So that may not result into some serious retracement, but certainly 19,790 to 850 zone may offer some resistance to the Nifty. Now, shifting focus on Nifty Bank overall remains relatively weaker as compared to Nifty. So in event of any consolidation or corrective retracement, we are likely to see Bank Nifty suffering more. That is one point. And the second point is that in next 100 odd points range, 100 odd points on Nifty Bank, around 225 points from 44,250 to 44,500. This is the confluence area of multiple resistances which are made up by 50 DMA and the 100 DMA. So yes, I see Nifty Bank staying under pressure so long as it is below 44,500.
All right, Nifty Bank likely to be under pressure as long as it remains under the level of 44,500. Hold that thought, Milan. We'll come back and talk about specific stocks with you as well. But let me also bring on board, Sanjay Agarwal, who's the Senior Director and Head BFSI at Care Ratings, to understand, what the new RBI norms mean for the entire financial sector and whether or not it will have any kind of impact on the fintech space as well. Good morning, Sanjay. Great to have you on the show. RBI has tightened norms for consumer loans a month after flagging of the rapid growth in unsecured loans, right? So this move would lead to more expensive personal loans as lenders have to keep aside more amount of capital for the loans to recover, in fact, to cover credit risk from a particular loan segment, right? As loans get more expensive, demand is going to, of course, take a hit. Do you think this would hurt loan growth and impact profitability for lenders going forward?
Yeah, good morning, Nandita. Good morning, viewers. So this move from RBI was expected to a certain extent for some time now. RBI has been raising its concern for the growth of unsecured personal loan, and the other part is the growth of banking sector exposure to the NBFCs. So there are twin things which have been covered, because if we see over the last, let's say, 12 months or something, the unsecured personal loans and the banking sector exposure to unsecured personal loan and banking sector exposure to NBFCs has been growing at twice the rate of the other lending of the banking industry. So this move was expected for some time. In terms of the loans being expensive, we feel that it would not be too much of an impact at a 15% capital adequacy rate and a 15% ROE. The entire impact is about 60 basis points. And the unsecured personal loan space, other than the prime space, which is largely catered to by the banks, but in the NBFCs, the range is somewhere between 14% to 36%. So we don't see that being too much impacted, but obviously there will be an impact. One is from the regulators' requirements for the banks and NBFCs to deal with the assets, and the other is the sentiments of the sector itself will get slightly hit.
Right, we'll talk about NBFCs in a bit, but what about banks? Which banks do you think will see the maximum impact of this move? Is this an opportunity for lenders with low retail exposure like HDFC Bank and Kotak Bank to race ahead of peers?
No, so we can't take specific names in our discussions, given that almost all these banks are our clients. But largely the banking sector, if we see the, let's say the capital adequacy norm, the banking sector is pretty well capitalized. So we don't see too much of an impact on that. The impact of the banking sector probably will be 30 basis points in terms of the capital adequacy requirement. But the sector is well capitalized. So we don't see any issues out there. There may be certain slowdown in some of the banks which have a significantly high level of unsecured personal loans. The largest impact will be on the prime unsecured personal loans because there the cost of lending would go up by at least, let's say, 35 to 40 basis points.
All right, that's the view then. But do you think the boards of many of the banks will have to reassess their growth strategies in these specific segments? The ones which do not have adequate capital buffer at the current juncture?
No, so we don't have any bank which does not have adequate capital buffer. The banking industry right now is a pretty strong state of affairs. The larger impact compared to the unsecured personal loan would be on the NBFC because that has been growing very fast and that is somewhere the yields are also competitive. So, I think that is...
talking about NBFCs, the likes of Bajaj Finance, Chola Finance, Poonawalla, do you think the impact there will be obviously much higher, and what kind of impact do you expect there? Because so Bajaj Finance has great asset quality, right? Is there any risk to asset quality going forward?
Yeah, we had a webinar recently on unsecured personal loan. So the opinion of the speakers, as well as our own in-house opinion, is that the entire sector has been tightening this, and especially since RBI has been coming out with its own, let's say, guidance for some time. So the sector has been tightening it. We have seen some amount of, let's say, increase in the delinquency, which was expected, given that there has been a significant growth in the past 2-3 years in this sector. But beyond that, we don't see any compelling sort of a credit risk as of now.
Right. Any impact on fintech players like Paytm, because they also have a certain exposure. In fact, they also give out certain, they give out loans, to certain customers, right? So any impact on fintech players like Paytm?
No, so the specific player you named largely does not carry too much of loan on its own books. They originate loans on behalf of others. So it is the people who provide the liabilities who would be more bothered about it. But as I said, many of these assets are high yield assets. So a 60 basis point probably may be a long-term impact rather than an immediate impact as such.
All right. And lastly, of course, there have been, the RBI has also tightened norms with respect to credit cards. For players like SBI card, do you think the impact will be more there, given the fact that, a company like SBI card is already troubled by declining margins and higher credit costs, right? So this would mean added burden.
So there are two parts, Nandita. One is the credit cost and the other is the return on capital. So return on capital also depends on how much capital you have vis-a-vis the business requirements. So RBI has increased the level of capital requirements, but almost all these NBFCs and banks are carrying significantly surplus capital. What will get impacted is over the long run when the companies chart their growth path. They will see that they require more capital for certain level of businesses, which then they will try to grow lesser than what they are growing right now. So as I said, immediate impact probably would be lower, but on the long term going forward, it will be on the higher side. The other thing is the regulators have been for some time cautioning, the market itself has been cautioning that the credit quality norms need to be improved. So the discussion we had with some of the people was that, let's say in credit cards, the approval rates have declined from 30% to 20%. So there's been a significant decline in the approval dates of the credit cards, which means that the system itself has been cautious for some time now. The larger point is the growth in, let's say, the assets. The unsecured personal loan in the lending to NBFCs has been growing by more than double the rest of the sector. So to that extent, the growth certainly would be coming down a bit.
All right. Of course, there will be long-term impact of the RBI move. But with that, Sanjay, thanks a lot for taking out time and sharing your thoughts with us this morning. It was a pleasure chatting with you.
Thank you very much.
With that, let's go back to Milan and talk about specific stocks. Milan, before I go and move on to other stocks, I want to get in your thoughts on an ICICI Bank. We have a query coming in on our feed on this particular bank from Akshay. Wants to know your thoughts on this one. Of course, private banks, of course, have taken a back seat, this year. Of course, vis-a-vis the outperformance that we saw last year. Stock has not done much, has been listless, so to say, over the last 6 months. But for somebody who's invested in an ICICI Bank, how should one go about playing it now?
So long as you are invested in ICICI Bank, you will need to maintain a stop loss of 920 on the stock, because the stock had momentarily slipped below the 200 DMA, and right now it is seen trapped between the 50 and the 200 DMA. So I think 920 should be maintained as a very strict stop loss, below which the stock can get weaker. On the upside, it will start finding some momentum only above 950 odd levels. So in between 920 and 950, we won't see ICICI doing much, and therefore 920 should be maintained as a stop loss.
All right, the stop loss level. Hope you took note of it, Akshay, and hope that answers your query. But let's talk about the stock of the day then. Delhivery, this stock will be on the radar today, given the fact that it's a money control exclusive. My colleague Ashwin Mohan broke the story last evening that SoftBank is looking to sell stake worth $150 million via a fresh block deal in Delhivery. Some of these new age companies have seen a very strong comeback this year, but Delhivery. Over the last, in fact, if you look at a YTD basis, this stock is up 25% or thereabouts. Going forward, do you think the shares will be under pressure today, given the fact that we will see a block deal in the counter? And if yes, what are the levels you'll be watching out for on the downside?
Under pressure, yes, if it is not able to move past 420 levels, because Delhivery has been in a sideways trading range between 410 and 440 over the past couple of weeks, and right now it trades below its 50 and 100 DMA. So yes, it has an overhead resistance from a technical perspective. I am saying between 420 and 435 levels. So long as it is below 430 odd levels, it might stay a little bit under pressure. On the downside, it has support at around 380.
All right, 380 levels to watch out for on a Delhivery. But aside of that, another stock that will be in focus today is a TVS Motor. Of course, the company has tied up, with a player to enter into the European markets. TVS Motor. It has been fairly okayish. In the last 1 month, it has gained somewhere around 4.5% or thereabouts. And two-wheeler makers have, in fact, been on a good, good trajectory, given the fact that Hero yesterday clocked a 3% kind of an up move and it was the top Nifty gainer, right? So, in this particular space, how is the TVS Motor, stacking up at the current juncture? The stock is very close to its 52-week highs. In fact, it did hit a fresh 52-week high yesterday.
Yes, the stock did do a 52-week high yesterday, and primarily it had started its up move the moment it went above 1390 levels, and it has more or less remained in a very secular uptrend. So right now, all we can do is to stay invested in the stock and keep trailing the stop losses higher. So right now, my take on the stock would be to stay invested and keep trailing the stop losses higher. And roughly as of now, 1620 to 1630 rupees should be trailed higher as a stop loss, and one should stay invested in this counter.
All right, the call is to stay invested in the stock, and of course it did hit a fresh 52-week high in yesterday's session. But let's also talk about some of the queries that are trickling in this morning. The first one is coming in from Kamala Nathan, and he wants to know your thoughts on a Kpit Tech. he wants to buy into the stock and he wants to know whether this is the right time to buy or should one wait for dips. Given the fact that the stock saw a very good rally yesterday, if you look at the monthly chart as well, it has given good 20% returns on a 6-month basis. It's a over 50% return coming in there. Do you think one should now wait it out because it has run up quite a bit? A buy on dip strategy is what you would be recommending on this one, KPIT Tech?
Yes, exactly. See, the thing is that KPIT Tech is in a very strong uptrend, and there are no second thoughts on it. The only thing is that it has run up too hard and it remains steeply overbought as well. So right now, if anyone who is making a fresh entry at the current levels, it may not come with a very good risk reward ratio. So it may so happen that the stock may continue to inch higher. But I would not suggest chasing the move. Rather, as you just rightly said, we should wait for some retracement to occur, and we should use the dips to make entry into the stock. But at these levels, I would give it a pass.
All right. For a better risk reward, of course, you should wait it out and not get into the stock at the current juncture. That's the call on a KPIT Tech. The next query is coming in from Peter William. Wants to understand whether it's a good time to invest in LXI Machine Works for the long term. Stock has been sideways, and of course, monthly chart suggests that the stock is down nearly 10%. But do you think this is the right time to nibble into it?
LXI Machine has got a very strong support in 12,400 to 500 zone. So if it is testing those levels, one can start accumulating LXI Machines in small quantities. So my suggestion would be not to buy or use up entire capital that is allocated for LXI Machines, but one should not mind exposing around 1/3 of the available capital and start accumulating the stock rather than going in all at once.
All right. Hope that answers your query on LXI Machine Works. The next one is on, Hindustan Copper. This one is coming in from Raja Pasala. He wants to know whether he can average at the current juncture or should he wait, or is there any chance of the stock heading higher from here? 159 is where it's, at the current juncture, just about, less than $20 away from its 52-week highs. The stock recently has done fairly well. I think just one of these days, it was up somewhere around 6 to 7% on the Nifty 500 index, right? So would you expect more upside? Do you think it will be crossing the 52-week high of 175 rupees or thereabouts soon?
Yes, I think so, because from the high point of 170, 171, when the stock saw the corrective retracement, it found support at 100 DMA, and right now it has rebounded from those levels. Now the thing is that the stock has got multiple resistances at around a multi-point resistance somewhere around between 162 and 163 level. So a better momentum will come only above 164. But yes, I see the stock inching higher towards its high time over the short term. So if one wants to add more, one can certainly add more on Hindustan Copper.
All right, that's the view on Hindustan Copper, bullish view coming in there. But next query is coming in from Debu K, wants to know your thoughts on a Dixon Technologies. The stock did lose some mojo off late, but it has been trying to regain its composure. In fact, yesterday, the stock was up somewhere around 3% or thereabouts. Any trading opportunity here?
Yes, in fact, Dixon has been finding support at its 50 DMA, and that level is presently placed at around 50 to 10. So one can, so far as taking a short-term view of the stock is concerned, one can stay long in the stock or even make a fresh entry. The only thing is that one will have to maintain a very strict stop loss of 5,200 on the stock.
All right.
Any slip below 5,200, one will need to exit.
5,200 is the stop loss that one should maintain on Dixon Tech. Hope that answers your query. The next query is coming in from Orson Fernandez, wants to understand whether he should average Polyplex at the current juncture. The stock is holding above that 1,000 level, but it's it's just come out of its 52-week lows. So do you think this is the right time to average?
No, I don't think so, because the stock has been under a secular decline. It's under a secular downtrend. It is attempting to find a base for itself, but there are no signs of any confirmation as yet. And there is no reason to believe that it will not inch lower from the current level. So right now, I would not suggest either adding more to this stock or even making a fresh entry yet.
All right, that's the view. Doesn't warrant a fresh entry at the current juncture. Next one, it's coming in on a Schneider Electric from Nitin Limai. Any thoughts on this one, Milan? Schneider Electric?
Schneider Electric, it is under corrective retracement right now. So if anyone is invested in the stock, one can continue to stay invested, maintain a stop loss of 315 on the stock. Making a fresh entry, I would not suggest to do it right now. One should wait for the stock to inch above 345 levels, from where it will find some fresh momentum. So at that point in time, one can make a fresh entry. But if anyone is anyway invested in the stock, then stop loss of 315 should be maintained. Fresh entry, we should wait until it moves above 340-45 odd levels.
All right, that's the view on Schneider Electric. A couple of more queries that I want to squeeze in this morning. Satya CK wants to know your thoughts on an HG Infra as to whether or not it's the right time to enter into this stock. HG Infra, I think, over the last 6 months, it has lost its mojo, even though on a YTD basis, it is giving good returns. Stock has been sideways over the last 1 month or thereabouts. Do you think it warrants a look before it hits that 1,000 mark? One should actually buy into it?
Not really, because from the levels of 930, 932 levels, which were its high point, the stock has undergone a corrective retracement and it has slipped below all its key moving averages. Right now, it's trading below its 200 DMA as well. So there are no signs of whatsoever that would suggest that a bottom might be in place. So I would not suggest entering into SG Infra at this juncture.
All right, avoid HG Infra at the current juncture. Hope that answers your query. This one query coming in from Hemant Kumar wants to understand your thoughts on a Vipro, and he's been, in fact, he can hold for 2 more months. IT stocks have made a very strong comeback. The likes of Vipro, TCS, they have seen good, recovery. And the view on the street is to actually accumulate these stocks now before the business recovery kicks in the last quarter of FY24 or rather first quarter of FY25. But for a 2-month perspective, how should one trade into a Vipro now?
That's a little tricky part of the story, because right now Vipro has tested its 200 DMA. So from 396 to 405, this 10 to 12 rupees range has got multiple resistances on Vipro. So I don't know what the situation of the person who has asked the question is vis-a-vis Vipro. If he's holding it, he should continue to hold it and trail his stop loss, or put his stop loss at around 388 levels, below which he should exit. Otherwise, his stock has got multiple resistance between 395 and 408 levels. A fresh momentum will come above 408.
All right, that's the view then. Just about a few more queries, that we can squeeze in. Ashok Kandukuri wants to understand your views on PNB, whether one should hold or exit. And at the same time, I would also like to ask you what to do with the Bajaj Finance. We have a query coming in on this stock as well. Of course, there is news flow surrounding, with respect to RBI's new norms on, unsecured lending. So some of these bank stocks and NBFC stocks will be in focus today. But particularly for PNB and Bajaj Finance, what are the levels you're watching out for on the charts?
All right. Let's begin with PNB first. PNB is in a secular uptrend. As I look at the chart, one can continue to stay invested in PNB and trail the stop loss to 75. Any slip below 75, one can protect whatever profits they are left with PNB and make an exit. But as of now, one can continue to safely stay invested in PNB. Coming to Bajaj Finance. Bajaj Finance is relatively weaker. Of course, we cannot compare Bajaj Finance and PNB in one breath. But in Bajaj Finance also, one can stay invested and keep the levels of 6,900 as a stop loss where the 200 DMA is. But otherwise, the stock is not so technically great. I mean, it doesn't warrant any fresh entry. But if anyone is already invested in the stock, there is no other option, frankly speaking, but to stay put with stop loss of 6,900 on it.
All right, 6,900 is the kind of stop loss that, of course, Milan is suggesting on a Bajaj Finance. With that, I think we've come to the end of this query segment. But before I let you go, Milan, what are you recommending for viewers this morning?
I'm looking at two stocks. The first is Titan. One can enter Titan above 3340. While maintaining a stop loss of 3220, one can expect 3450 on it. The second stock I'm looking at is buying Hindalco. One can enter Hindalco above 505, and while maintaining a stop loss of 490, one can look for 535 odd levels.
Right, Titan and Hindalco, two recommendations coming in from Milan. With that, Milan, thanks a lot for taking out time and joining me this morning and sharing your thoughts with us. So, as usual, it was a pleasure chatting with you.
My pleasure.
Well, with that, we've come to the end of this edition of Morning Trade. From me and the entire team, thanks a lot for watching. But don't go anywhere, because coming up next is Opening Bell with Santo.